where we did see big declines, where you would expect to see big declines, quite frankly, the sectors that have always been the highest beta and the most volatile on the back of this. And of course, if you are going to see travel restrictions imposed and in some areas, foreigners banned from flying into a country or anyone flying into a country or out of a country for that matter, then you are going to see travel and leisure hit disproportionately. You are going to see energy stock hit disproportionately. So I thought actually in a shortened session with liquidity issues in the United States, because of course, you had the Thanksgiving holiday on one side and the weekend on the other, I thought the markets behaved beautifully in many cases as well. And if you were trying to sell stock, you would be able to get on, albeit at a lower price than you wanted. And bearing in mind, and I'll tell you now, that we are away from the record high on the S&P, the biggest measure of these three, only by 3.2%. So we're 3.2% from the highest levels ever achieved intraday on the S&P. I don't think that's bad, considering everything that's been thrown at these markets. And all those concerns, of course, about interest rate hikes that we had at the start of the week, which meant on treasuries, we had a 160 handle. We went down to a 148 handle at our lows on Friday, where we closed. Now we're back up to a 152 as well. So again, decent enough liquidity for you to be able to put your trades on in the 10-year, in the 5-year, the 2-year, and the 2-year trading at 0.543 as well. Should we have a look at where the Asian markets are trading as well? The Nikkei was getting it earlier on and down 467 points was the last print on that as well. 0.9% easier for the Hang Seng. Moderate declines on the Shanghai Composite, virtually at the flat line. And the ASX 200, heavily commodity oriented, down 0.5%. Again, the VIX. Don't overdo this, don't overdo your thinking when you see this. Look, 54% higher on the VIX. What it meant was that people who wanted to buy at the money, most active, liquid options on the near a month contract were paying more for their contract. So a 28 handle on the volatility indicator. Yes, it has spiked. There is no doubt about it. It has spiked. But if you look at that spike, not a million miles away from the previous spikes we've seen 4 or 5 times already the year. That will abate aggressively. One thing that is interesting is you don't often see that on a bank holiday weekend with Thanksgiving one side and indeed the weekend the other. So yeah, that was an extraordinary move in some ways. But again, there was lack of liquidity. But if you wanted to buy your options, you got on to the trade. Let's have a look at the futures now, actually. We haven't looked at the futures for Europe yet. And there is a rally, but this is very much a derivative, I would suggest to you, of what's going on the US futures. But we'll spend a bit of time here first. So the CAC futures, 6,800, 15,500, give or take the change on the DAX. The FTSE, which was challenging 7,000 in terms of the cash, not the futures, but seen up now 71.23 as well. So let's take a look at those US futures. They've been higher, they've been lower, but currently trading towards the top end, I would suggest, of the pre-market range that I've seen since I was up having a look, dare I say it, at 3 o'clock this morning. 207 higher for the Dow, S&P 38 points higher, and the NASDAQ 172 points to the good as well. Let's get to Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley. Andrew, I've been talking about how logical I thought a lot of the market action was on Friday, but what do you think, and what do you think we should be looking at as far as today's session is concerned?
Yeah, good morning. Look, I think the action was certainly logical in the direction. I think exactly as you mentioned, what we saw was a market expressing greater fears around growth, which seems like the logical outcome to concerns around a virus that is, as Dr. Fauci was just saying, it looks potentially more contagious, potentially raises some risks around evading vaccines. And so we did see more cyclical assets respond in a larger way than exacerbated by, post-Thanksgiving liquidity or the lack thereof. But look, I think it is important to step back and think that there's still a lot that we don't know, important factors that we don't know about this virus that won't be clear probably for a number of days. And also, I think as we step back and think about some of these dynamics, it could change the path of growth, but it might not.
Right. So what we're going to do is we're going to just, put another 5p in Andrew's broadband connection or something like that. I don't know, but we'll get there in a minute. But Andrew Sheets there talking about what he saw as pretty logical markets, a certain degree of illiquidity. And we just have to, have we got Andrew? Let's try one more time. Andrew, I believe we may have you back. Sorry, you were talking, sir. No. Okay. Thanks for that, Will. Right. Okay. Coming up on the show, oil rebounds. We'll try and get Andrew back. Oil rebounds after its worst rout its worst rout in more than a year. On speculation, OPEC Plus producers may increase output. We'll be back after a short break.
Good morning, guys. Good afternoon, depending where you are. On Asia, I said we're looking for short euro yen, and we will put stop up above 128.40, and you can see we did about 60 pip. We usually do in London gold trade, and our target is 15,000 a month. I just took short right now, buy signal on gold. Like I said, our target 15,000. We are right now 16,000 for the month. If we get 17, 18, 20,000 would be great, but I'm long gold. Also, we did a trade on OCCAD early on Friday. We had 83 bib and OCCAD short. In case if you missed it on Asia. In Forex account, we did about I have two accounts. One is gold and one for Forex. The Forex account, we did about 26,000 last month.
Right, so we're up about 1% on European futures. Andrew Sheets is back with us, Chief Cross-Asset Strategist at Morgan Stanley. Let's try again, Andrew. Let me move the conversation on slightly. Every single decline, 1 or 2 day decline that we've seen on equity markets of 2021 has been a brilliant buying opportunity for our viewers as well. Is this one the same, or is it something different this time?
Well, thanks. Look, I mean, I still think there's some pretty important things we don't know yet about this virus, that we don't know yet about key factors, about how contagious it is, or about vaccine, its ability to avoid vaccines. But look, I think taking a step back, I think if we think about some of the markets that saw the largest decline, say on Friday in low liquidity, markets like Europe, they're now trading at valuations that are very close to kind of the 5-year average, with what we think is going to be very strong earnings growth and a pretty strong economic backdrop next year. So, look, I think this is a time when we should be investors should be sharpening their pencils and thinking about some of those more growth-sensitive names that have sold off. We at this point don't think the growth picture has changed materially. Looking out into next year, and again, I think whenever you see the VIX above 20, let alone 28 where it is today, it's a sign that there's generally more fear, a little bit more disorder in the market, and that generally does present a better short-term buying opportunity. So I think still a lot that we want to know, but I think for markets like Europe, we still have solid double-digit upside over the next 12 months, and think that will be an attractive market for investors to hold.
Yeah, look, I mean, ordinarily, I would have started off the conversation today with saying the key events of the week. I mean, it's really a lot of good data this week. We've got testimony coming up as well, but it's the payroll week as well. It's the most exciting bit of data in any calendar month as well. And it should according to the pundits, be a really good figure as well. Increased pressure on the central banks, or actually has that abated now because of these Omicron concerns?
Yeah, no, I think it'll be fascinating, right? Because so you've already, I think, had it going into this before this variant news, this idea that, well, maybe the Fed would still be patient on raising interest rates, but it might start to taper its purchases faster, that's how it would respond to some of this increased inflationary pressure. So that will be, I think, an important factor to watch, which obviously the jobs data could influence. The way that we think at Morgan Stanley this will ultimately play out is the market will actually price in less hikes in 2022. The market's currently priced for the Fed to have liftoff around the middle of the year. We think they don't actually hike until the first quarter of 2023. But then for the market to price in more hikes after that. So kind of later start, then faster pace after. And I think if we see more damaging news about a variant come out, then that could also reinforce this idea of let's be patient. But then once we do start, from a Federal Reserve perspective, we'll hike rates faster.
We've all been very critical of, well, very strange, unorthodox Turkish central bank policy under political pressure, should we put it. But I mean, if you've got a core deflator, PCE, at double the rate of which is the target inflation rate in the US, Andrew, I don't see how you can wait till 2023 when you're seeing numbers like that. I mean, it's positive that there's a little bit of inflation back in the system, but we don't want this running away, do we?
Well, I think from a Fed's perspective, there are two factors that I think are important. The first is that we think by the time they get to kind of the middle of the year, when say this debate around liftoff is going to be most intense, that same core PCE deflator is going to be declining and moderating as we think some of the supply chain pressures ease. So if that happens, we think that would take some of the pressure off of the Fed. If it doesn't happen, then it would be a different situation. Now, I think it's very fair that right now, I think prior to this variant, there was no incentive, very little incentive for the Fed to communicate any sort of potential dovish message yet. The variant obviously complicates that a little bit. But our view is that by the time you get kind of into March, April, May, it's going to be more clear that we're past the peak of inflation, that the participation rate in the U.S. is still going up. And we think that those factors together could give the Fed just a little bit more leeway to wait a little bit longer, but then ultimately move faster once they do.
Sure about the participation rate, Andrew. I mean, I see a lot of soul searching about it. We're in the low 60s now, very low 60s, 61 handle on that as well. Are we sure that something structural hasn't happened to the US economy, i.e. over a longer term period and throughout COVID? That means we're just not going to see the participation rate as that meaningful marker that many economists want it to be.
Well, I'm really glad you asked about that. I mean, I think without exaggeration, this might be the most important piece of economic data coming out of the U.S. If the participation rate can rise, it's a sign that there's slack still in the economy, that the Fed can be a little bit more patient, that you're not at full employment, and that maybe some of this inflation concern is a little bit overdone. But on the other hand, if participation doesn't rise, if, as you mentioned, that maybe there has been more permanent damage done to the labor market, to the supply of labor, that's very bad. That does suggest that you are already at full employment in the U.S. or near it, and that would suggest a much faster pace of tightening than either we or certainly the market is expecting. So I think it's an incredibly important element of data. We do think there's some good reasons why the participation rate can rise going forward, but if it doesn't, it really complicates the picture and makes it a lot more difficult, I think, for investors in a lot of different asset classes.
Always a pleasure, Andrew. I'm glad we got there second time around. Good stuff. And have a great week, my friend. Thank you very much for that. Andrew Sheets, Chief Cross-Asset Strategist at Morgan Stanley. Let's take a look at what the World Health Organization is saying at the moment as well. I've just got a series of flashes coming out. Depending on characteristics of the Omicron variant, there could be future surges of COVID-19, which could have severe consequences, so says the WHO. Overall, global risk related to Omicron is assessed as very high. Urges its member states to report initial Omicron cases in clusters and thereafter the proportion amongst sequenced samples. I guess there is a reticence from some now. If you look at what's happened in South Africa, you think, well, if we're going to report and we get penalized by the international community shutting off our borders, Yeah, you can understand the conundrum, I guess, but I mean, the broader health concern is more important. So they're urging member states to report initial Omicron cases and clusters, urges its 194 member states to accelerate COVID vaccination coverage amongst high priority groups. The likelihood of potential further spread of Omicron at the global level is high. That's what the WHO is saying in a technical brief to its 194 members. Use a risk-based approach to adjust international travel measures in a timely manner, says more advice will be forthcoming. Okay, so Japan is set to close its borders to all foreigners from Tuesday. The Prime Minister, Fumio Kishida, said the government was responding to the Omicron variant with a strong sense of urgency. Nissan, meanwhile, has unveiled its new long-term strategy. The Japanese car maker's new roadmap will see it spend almost $18 billion over the next 5 years as it looks to electrify more of its lineup. The company will introduce 23 new models by 2030 and aim for more than half of its sales to be electrified. Let's take a look at Nissan shares. They were down, they've actually gone down even more than they were when we last looked. They were 4.7% lower, now down 5.6% easier. But the Nissan CEO, Makoto Uchida, told me earlier that the global semiconductor shortage was starting to ease a tad.
It's still getting better by better, step by step, but we need to carefully to monitor and how we can make sure to have our business continuity plan, not only by Nissan, but also as an industry, how we can support each other with a partnership is going to be very important, and that's what we are doing today.
Let's get to look at the crude price. Rebounding, a solid rebound, if unspectacular compared to the declines we saw. We saw a $10 plunge on Friday. It was the biggest one-day drop since April of last year. Anyone else remember what happened in April last year? I'm sure you do. Dan remembers what happened on the April expiry last year. Dan, I see that Mr. Novak, Deputy Prime Minister, is talking about Russia needing no need for urgent measures in the oil market, adding that partners have not asked for renegotiation of the deal because of the strain of COVID-19. Take us away. What else are you seeing in the oil market, Dan?
Yeah, so Steve, that's an interesting take from Russia's Novak. And of course, he has an important voice in the OPEC Plus calculus because they are going to be meeting this week and they're going to be deciding exactly how to counterbalance not just the SPR, but also this new COVID variant, which has wreaked havoc across the market. I spoke with the NE CEO, Claudio Descalzi, just about a week ago. And I know you speak with him often as well, Steve. He told me that a new variant would be the greatest risk to the market in 2022. It happened sooner than we thought, but he was on the money. And it's interesting as well, I know you've been talking about this today, but the price rebound that we're seeing has some analysts basically questioning whether or not this sell-off on Friday was overdone. We saw oil collapsing by more than 10% coming into the weekend. That was its largest one-day drop since April of 2020. And I think the reality is here, the demand shock that Omicron could cause, especially if borders continue to close, as we've seen today, that could lead to grounded flights, it could lead to new lockdowns, it could lead to new quarantine rules. That is really the biggest worry that the market has right now and the biggest worry for the broader economic recovery as well. As I mentioned before, Japan has suspended entry for all foreign visitors today. We're already seeing border closures in Israel and other travel restrictions at the weekend as well. All of this are really adding up to be some pretty complex math for OPEC Plus, who have also decided to update their own calendars and buy more time to decide what the next move on the chessboard is. As it stands, OPEC has about 3.8 million barrels per day of cuts still in place. And analysts say the group might pause with those increases now, given the possible impact that this could have on demand. They have also already warned of a supply surplus into next year. So any decision to ease up on supply could be a politically challenging one as well, given the White House's recent calls to pump more. At the same time, though, given the rebound that we're seeing right now, OPEC Plus might also decide to stay the course, looking to maintain perhaps a sense of calm here and a sense of control. And as I mentioned, we're already seeing oil recouping some of those losses. So that's good news for the OPEC Plus group when it comes to extending the overall supply push that they have been doing over the past few months. But this new variant might actually force them to pause. All remains to be seen later on in the week, Steve. We'll watch it closely.
Nice work, Dan. Thank you very much indeed for that. I'll just tell the viewers one or two more WHO flashes that are coming out. Omicron has unprecedented number of spike mutations, some of which are concerning for their potential impact on the trajectory of the pandemic. So says the WHO. We're going to take a very short break. Shall I show you the futures? I might as well do that. We are between 1 and 1.4% higher on the major European bourses. We'll be back after a short break.
Okay, in case if you missed it in Asia, we said euro dollar usually go higher for last 20 years. On Thanksgiving Day, on Friday, we went from 120 to 130, 112, 113.20, which about 120 bips. And the Nasdaq and YM was higher the day before Thanksgiving also. Now on Friday, after the market close, we get COVID news from South Africa. That's why the market sold off hard. And we try to rally right now. Now, if we're going higher, we need to trade above those three lines. Because this is a downtrend, and if we staying before this, under this three line, this means we are still in downtrend. And this is gonna be depend all the news after they analyze the news about COVID and what Europe doing and everything. Because like I said on Friday, they said, let's sell and see what happens. We will figure later what's going on around the world. We can understand later what's going on. But the best trade is to sell first. Then after everything is clear, they can go back again to the market. So the oil drop because the pandemic was, I guess everybody is gonna stay home. Nobody's gonna order crude oil to go to work. You need to fill your car in gas station. When the pandemic started, like last 2 years, the oil was dropped very fast. So the same thing happened here.
The WHO says the global risk posed by the Omicron COVID variant is very high and urges member states to ramp up their vaccination programs.
Let's hope this is a dress rehearsal, because unless we move on vaccine equity, the virus will really develop something that we are struggling to get ahead of.
Asian equity markets slip, but US futures actually gaining as Wall Street looks set to recover some of Friday's heavy losses. Crude prices also rebounding, having plunged $10 for their biggest one-day drop since April of last year, prompting OPEC to delay its meeting this week. Japan announces plans to close its borders to foreigners from Tuesday amid the spread of Omicron. But the Nissan CEO, Makoto Uchida, tells me the supply chain squeeze is easing.
It's still getting better by better, step by step, but we need to carefully to monitor and how we can make sure to have our business continuity plan, not only by Nissan, but also as an industry, how we can support each other with a partnership is going to be a very important.
Asian indices look like this. So measured declines, 1.6% lower for the Nikkei. The Hang Seng still live down 0.8%, flat on the Shanghai Composite. And
all right, guys, I did close our gold long for 678, and this will put us about $16,092 right now. And the Forex market also, we are above 26,000 this month. So 26,000 and 16, 17,000 on gold, which is not bad. It was a good month. And if you're interested to trade with us, you can come to our chat room and trade live with us. Thank you very much, and you have a great day, everyone. Take care.
Increased caseloads of COVID-19. The group said the risk assessment associated with Omicron variant is, quote, very high, and that it could lead to future pandemic surges with severe consequences. The WHO also told countries to use a risk-based approach to international travel adjustments. South African authorities are considering making COVID-19 vaccinations compulsory for some places and activities after infections nearly tripled in the past week. The President, Cyril Ramaphosa, said the newly emerged Omicron variant is responsible for the spike in new cases, but the government has so far not imposed stricter lockdown measures. The President also criticised other countries, including the UK and the United States, for imposing travel bans, calling that action deeply disappointing. Well, let's get to Fifi Peters, who rejoins us now with more from Johannesburg. And as we've said before, Fifi, it is that cruel irony that the excellent work that the South African scientists have done to tell the world about this variant as well has led to the country being punished with not so much being internationally ostracized, but people taking extreme caution about travel to and from South Africa.
And that's the thing, Steve. While the country actually has, acknowledged the swift response that many countries have taken against Omicron and has understood it to some degree, the point of contention comes from the fact that the continent feels that Southern Africa is not being treated the same as other parts of the country, mainly richer nations in which the variant has also been identified, and that travel restrictions on these countries have not been forthcoming. The president yesterday in the televised address actually went as far as saying that the G20